Well, equities are trading pretty much based on sentiment, not necessarily fundamentals. I think what we see here is in the US, for instance, the path of least resistance seemed to be up. Again, it's headlines regarding trades. One day it's positive, one day not so positive. But the main reason why equities are going up has to do with central bank policies. I mean, don't forget, the Fed has cut rates 3 times since June, has also added 280 billion to its balance sheet with interventions in the repo market. That's another 50 basis point cut effectively. So the path of least resistance seems to be up. And as far as Asia is concerned, of course, sentiment shifts with news on the trade front. So I think for now, there's no need to change any strategies. I think sentiment, central banks will see higher equity prices, but fundamentals, which are not necessarily improving, in fact, they might be deteriorating, would favor long-term US Treasuries. So we're still bullish on the 10-year Treasury bonds, and we think that Treasury yields will go quite a bit lower over the next few months.
Of course, as you mentioned, central banks have been supporting equity markets with lower rates, but do you see that coming to an end as we approach 2020 and, of course, move into the next business trading year itself, because a number of central banks pausing as we've moved into the end of this year, particularly around the Asia-Pacific region? Do you see further easing from central banks in this part of the world, and will that continue to then support equity markets here beyond New Year's Day?
I think you would have to believe the narrative that the global economy will see a cyclical recovery in 2020, and we're not convinced about that. So we think the Fed is not done raising rates. At the moment, they're pausing. They want to see what's happening, the data that's coming in, and I don't think they will raise rates in December, but there's a good chance that they will, cut rates in December. They will cut rates probably in 2020 in response to a deteriorating economy. I mean, we have CapEx is in recession, manufacturing is in recession, and the only thing that holds up the market is the services sector, in other words, the consumer. That's 70% of the economy, but the recession in manufacturing and CapEx may actually spill over. So we think the central banks will be forced to ease again. About Asia, I mean, Asia is a bit different. I think in Asia we have a lot more orthodox monetary policies than in Western countries, but I think the Fed here is key, and we believe they're not done cutting rates.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.